Picture this. You spend 30 years doing the right thing. You contribute to your traditional IRA or your 401k every single year. You watch the balance grow. You feel good about yourself. And then retirement arrives, and the IRS shows up at the party like an uninvited guest who was technically always on the list. Because every dollar you pull out of that traditional retirement account gets taxed as ordinary income. The money you saved for decades is not fully yours. A piece of it belongs to the government, and the percentage depends on how much you pull out, which bracket you land in, and decisions you may not even realize you are making. But here is what most people in that situation do not know. There is a completely legal IRS-approved strategy that lets you systematically move that money out of the taxable pile and into a bucket where it grows and comes out completely tax-free for the rest of your life. It is called the Roth Conversion Ladder, and by the end of this video, you are going to understand exactly how it works, who it is built for, and how to execute it step by step. Let's get into it. First, let's make sure we are starting from the same place, because this whole strategy only makes sense once you understand the difference between the two main types of retirement accounts and why that difference matters enormously in the long run. A traditional IRA or 401k is funded with pre-tax money, meaning you get a tax deduction when you put the money in, it grows tax deferred, and then you pay income tax when you pull it out in retirement. A Roth IRA is the opposite. You fund it with money you have already paid taxes on, it grows completely tax-free, and when you pull it out in retirement, you owe nothing. Not a dollar, not a percentage, nothing. The Roth is the end destination. The traditional account is where most people's money currently lives. The Roth Conversion Ladder is the bridge between those two places. So what is a Roth conversion? A Roth conversion is simply the act of moving money from your traditional IRA or 401k into a Roth IRA. You pay income tax on the amount you convert in the year you convert it. Because remember that money was never taxed when it went in. And then from that point forward, the converted money lives in the Roth, grows tax-free, and can eventually come out tax-free. The whole strategy of the Roth Conversion Ladder is to do this systematically over multiple years, in a way that keeps your tax bill as low as possible while moving as much money as possible into the tax-free bucket before the IRS forces you to start taking money out of the traditional account, which happens at age 73 through something called required minimum distributions. Once those kick in, you lose control of the timing. The ladder is about moving strategically before you lose that control. Let's talk about why the gap between retirement and age 73 is the golden window for this strategy, because this is the piece that makes the Roth Conversion Ladder so powerful for people who retire early or have flexibility in their income. When you retire and stop receiving a regular paycheck, your taxable income often drops significantly, maybe dramatically. And lower taxable income means you are sitting in a lower tax bracket, sometimes the lowest you have been in since your 20s. That is the window. If you are in the 12% federal bracket or even the 22% bracket, converting a chunk of traditional retirement money and paying tax on it now at those lower rates beats leaving it in the account to be forced out later at potentially higher rates when RMDs stack on top of Social Security and push you into a higher bracket than you expected. You are not avoiding taxes forever. You are paying them now at the lowest rate you are ever likely to see and then never paying taxes on that money or its growth ever again. Here is how the ladder actually works, step by step. Step 1 is figuring out your conversion amount. Every year during the conversion window, you look at your total taxable income for that year, figure out how much room you have left before hitting the next tax bracket ceiling, and convert up to that amount from your traditional account to your Roth. For example, if you are a single filer in 2025 and the top of the 12% bracket sits at around $47,000 and your other income for the year, Social Security, part-time work, whatever it is, totals $20,000, you have roughly $27,000 of room in that bracket. You could convert up to $27,000 and pay only 12% federal tax on it. That is your rung for that year. Next year you do it again, and the year after that. Each annual conversion is one rung on the ladder. Step 2 is the 5-year rule, and this is the one most people miss, and it is genuinely important, so pay attention here. Money that you convert into a Roth IRA has to sit there for 5 years before you can withdraw it, penalty-free if you are under 59 and a half. Not 5 years from when you opened the Roth account originally. 5 years from the date of each specific conversion. So if you convert $20,000 in 2025, that specific $20,000 and its earnings cannot be touched penalty-free until 2030. This is why the strategy is called a ladder. You are building it one rung at a time so that by the time you need to access the converted money, the 5-year clock on that particular conversion has already expired. If you start the ladder 5 years before you plan to need the money, the first rung is unlocked right when you need it. The second rung unlocks the following year, and so on. The ladder keeps paying out while you keep building it from the top. Step 3 is managing what you live on during the conversion years. Because if you are converting traditional money to Roth and paying tax on it every year, but you also need income to live on, you need a source of funds that is not the traditional account. Otherwise, every dollar you pull out for living expenses is stacking on top of your conversion amount and potentially pushing you into a higher bracket than you planned. This is where a taxable brokerage account, cash savings, or Roth contributions you made years ago that can be withdrawn anytime without penalty become genuinely valuable. The cleanest version of this strategy uses non-retirement savings to cover living expenses while the conversion happens quietly in the background, keeping your taxable income controlled and your conversion amounts optimized. Step 4 is watching the brackets carefully every single year, because the tax brackets are not fixed forever, and your income picture changes. In some years, you might have a capital gain from selling something. In others, you might have higher medical expenses that create deductions. A good tax professional or fee-only financial advisor who understands this strategy can help you fine-tune the conversion amount each year to stay exactly where you want to be in the bracket without accidentally tipping over into the next one. This is not something you set once and forget. It is an annual calibration that pays for itself many times over in tax savings. Now let's talk about who this strategy is actually built for, because it is not for everyone in every situation. The Roth Conversion Ladder works best for people who retire before their required minimum distributions kick in at 73 and have a window of lower income years to work with. It works best for people who have a significant amount of money sitting in traditional pre-tax accounts that will eventually generate a large tax bill whether they plan for it or not. It works best for people who have some non-retirement assets to live on during the conversion years, so they are not forced to take large taxable distributions on top of the conversions. And it works best when it is started early enough that the 5-year clocks on each conversion are expired by the time the money is actually needed. If you are already 70 and your required minimum distributions are already arriving, this strategy is less useful because you have lost the window. If you are 58 and planning to retire at 62 with a decade before required minimum distributions begin, you have a genuinely meaningful opportunity sitting right in front of you. The goal of the Roth Conversion Ladder is not to never pay taxes. That is not quite what the title promises, and it is worth being honest about that. The goal is to pay taxes once, at the lowest rate available to you, and then never pay taxes on that money or its growth again for the rest of your life. In practice, for people who execute this strategy carefully across 10 to 15 years of retirement, the lifetime tax savings can run into the hundreds of thousands of dollars. Not from anything aggressive or complicated, just from understanding the rules, using the window that retirement creates, and moving money deliberately from the taxable pile to the tax-free one rung at a time. If this is the first time you have heard about this strategy and it made something click, go talk to a fee-only financial advisor or a tax professional who specializes in retirement planning and ask them specifically whether a Roth Conversion Ladder makes sense for your situation. The conversation is worth having before the window closes. This is exactly the kind of thing this channel exists to put on your radar, so you know to ask the right questions before it is too late to act on the answers. We are still a small channel just working toward our first 1,000 subscribers, so if this helped you, hitting subscribe genuinely means the world to us and takes about 2 seconds. Thank you for watching all the way through. The next video is right there on your screen, and I will see you there.